Assalamu alaikum. Good morning, everyone. Thank you for joining us for the fifth session of AlNukhba Program. In today's session, we will focus on investor relation and disclosure, which is an essential topic for any company that's preparing to get listed on the Qatar Stock Exchange or is already listed. We will explore how clear and consistent communication with the market can build credibility, investor confidence, and long-term value. We are pleased to welcome two speakers from Maroon Capital Advisory, a leading independent corporate finance advisory firm based here in Qatar. We have with us today Mr. Sebastian Strathmann, who is the CEO of Maroon Capital Advisory. He brings over 16 years of experience in IPOs and equity capital markets, with 8 years at BNP Paribas in London and another 8 years here in Qatar. He has completed over 100 transactions across the IPOs, listing, equity-linked product, and M&As. His recent work include the listing of Vima, which is a QAR 842 million on the QSE main market, and Al Holding transfer from the venture market to the main market. We also have with us Mr. Hosam Mekdad, who is the director at Maroon Capital Advisory. Hosam brings 16 years of investment banking and consulting experience, with a focus on IPOs, equity capital markets. He also worked at some of the largest transactions on the Qatar Stock Exchange, including Said Petrochemical, Camco, Baladna, and QLM. And he was recently involved in the Bima and Al listings. A quick reminder before we begin that all microphones are muted. So if you have any questions, please enter it in the Q&A section. Sebastian, Hosam, the floor is all yours.
Thank you very much, Mr. Suleiman. Assalamu alaikum. Good morning, everybody. Pleasure having you today in our session as part of the AlNukhba Program. Very pleased for the Qatar Stock Exchange to have initiated this fantastic program, and we hope it is of value to you. Today's session, as Mr. Suleiman said, focuses on investor relations and disclosure components. I believe many of you have met Hosam and myself. As said beforehand, as Mr. Suleiman kindly said, Hosam and I together, we are working for more than 8 years together as a team. 4 years at a previous employer and now 4 years with Maroon Capital. We've done quite a few transactions together and are very happy always to share our views, our experience, and together with some practical tips, I would say. Today's session, as said, is focused on investor relations and disclosure. We split the presentation into 2 parts. Part number 1 is investor relations and disclosure prior to the listing or prior to the IPO. And part 2 reflects investor relations and disclosure and is a bit more focused on the rules and regulations for companies that have just listed on the stock market. Why does investor relations and disclosure matter before the bell rings? Ultimately, it's very straightforward. The company that intends to list on the stock market or wants to IPO on the Qatar Stock Exchange will disclose certain information in line with the regulatory requirements, but beyond the regulatory requirements, it's at the company's and the advisor's discretion what voluntary information we want to disclose. And fundamentally, any investor, the regulator, as well as the media, they will only be able to assess the information that we disclose together. So the strategic consideration of what information will be disclosed and how we position that information towards investors, towards the regulator, towards the media is very, very important. Why is it so important? Number one, of course, having a very clear and structured communication strategy and positioning of the company should reflect in the interest and demand by investors. It should also support the trust in the company and the overall perception of the company as a newly listed company or company to be listed. We need to ensure that we comply with the regulatory requirements. And very important, the entire positioning, in our view, has a significant impact as well on valuation and perceived valuation. If we have a look at what is the framework, effectively all disclosure which is being done and work on the investor relations side is not easy, I would say. It's not easy in the sense of having a very clear balancing act between, on the one hand, we want to market the company to the maximum. We want to ensure that all the effort the founders, the senior management has put into building the company over the previous years will be reflected by investor interest to the maximum. At the same time, we need to balance this against liability. Liability management in the sense of ensuring that the company and all its advisors are ensuring that all information which is presented is factually correct, is not misleading, and cannot be misinterpreted. And it's a very, very fine act. How do we manage this effectively, like together with our clients, and how we recommend for companies and senior management teams to endeavor? There's one key document. The key document in the entire listing application and the process itself, which is the prospectus, the listing prospectus or IPO prospectus. That is the key document which is being reviewed and effectively approved by the regulatory authority. The Qatar Financial Market Authority ultimately will approve that prospectus. And that prospectus is the core document on which all other communication ultimately should be based on. Us, for example, when we work with clients together, we really focus on ensuring that the prospectus covers all components, all key communication, all marketing messages, and ensures that also all potential risks are covered within the prospectus. And any other document that we produce, and I'll come to this in a second, all other documents effectively need to ensure that they are in line with the prospectus. Deviation from the prospectus in communication and messaging can create so many different challenges and interaction with any third party. That's why core document should always be the QFMA approved prospectus, and anything that is being produced in addition to the regulatory required documents as voluntary disclosure should always be aligned with the prospectus. We have listed here on that page a few best practice in disclosure. I think they are quite self-explanatory. Of course, ensure that you use the right disclaimers and the appropriate disclaimers. That should not necessarily be a copy-paste from any previous transactions. Disclaimers need to be adjusted to the specific situation and also to the information which is being shown. We see very often, and we have a lot of discussions with clients on ensuring that the facts, and there's a clear differentiation between facts and ambition or aims of the company. And that is something that we see very often, like where we together with the legal advisor spend a lot of time in ensuring that across all investor relation documentation and disclosure, there's a very clear distinction between historical facts and the future of the business, of the ambition of management, strategic vision and plans of the business. And that's not always easy. Why isn't that easy? Because the prospectus effectively has a specific cutoff date. And whatever is the date of the prospectus is effectively the status quo. So when drafting the prospectus, like when we've been drafting together with the various teams, the various components, we attempt and we try to envisage at what point in time effectively will the prospectus be published? So what is the factual status quo as of the date of the prospectus publication? Financial statements, of course, is easy. We have audited and reviewed financial statements that are being expressed, but other corporate developments, strategic corporate actions, these are important to carefully evaluate and assess at what point in time can we factually describe something as a fact, and what remains an intention, or what remains a specific plan for management or senior management and board of directors to act. Of course, exaggerations and other components need to be very clear. Any statement that we make across the documentation should always be found on facts or supporting documentation, third-party sources, ideally, if possible. We know in Qatar this can be sometimes a bit tricky. If for specific sectors we don't have market share information, for example, or substantiating oneself from other competitors if they're not listed on the stock market already, obtaining information can be sometimes a bit tricky. But that just needs a careful consideration of, as said before, like what can be firmly stated and what can be communicated as an aim, an ambition, a target of management. Unifying messaging across the documents I mentioned before already, common missteps and actions to avoid, forward-looking statements. That's always a tricky one. On the one hand, we want to ensure that the audience fully understands the potential of the business and the future potential of the business. Our view and recommendation is to avoid having specific numbers in documentation, because effectively that just creates specific liability. However, we encourage our clients to provide an outlook, a guidance. The guidance can be qualitative or of quantitative nature. Qualitative nature can be expressing growth versus historic periods, can be specific measures that management has already implemented and is expecting specific outcomes. And more quantitative measures could be, for example, giving a guidance, a range of revenue increase over a certain period of time, or could be a guidance on net profit margin targets, not net profit absolute numbers, but margin targets. If we look at what is a toolkit in our view, what are the key documents that prior to the listing, the senior management team and the investor relations officer should focus on? We have the investor presentation, which in our view is the core document, effectively the key marketing document to the outside world. That is normally a 20-30 pages presentation, ideally in English and in Arabic, that effectively summarizes the key components of the company, the vision, historical financial performance, and the equity story to the investors. Prospectus I mentioned already. That's the one document that we really need to carefully assess and manage and balance carefully liability versus marketing. We recommend to have and create fact sheets as well. Fact sheets, effectively one page, as the name says, purely the facts about the intended and approved listing details or IPO details, which can be shared with any third party without any conflict. And along with these, on our side, we recommend our clients to develop together with us also social media strategy, to ensure that we capture all age groups and all potential investors for the listing or for the IPO. IR website and the IR website, Hosam will talk a bit later or touch upon this later. The requirements under the QC IR guidelines. We also recommend to have to develop a specific questions and answers pack for the senior management and board of directors. to ensure that there are unified messages to the key questions that we expect from investors. That doesn't sound that challenging, but as you can imagine, not all board of directors members necessarily know all the details or specific answers about strategy going forward, specific intentions. So what we do, following the approval of the regulatory authorities, to convert into a public shareholding company when the first announcements are being made in the process, we'll put together a very specific, most frequently asked questions and the specific answers document that we share with all senior management members and board of directors, anybody effectively who could have potential contact with third parties, may this be media, investors, or the regulator. And lastly, very important in our view, not just because I'm German, but it is important effectively for effective planning and communication, is we need to put a disclosure calendar together. Disclosure calendar in the sense of the 1 to 2 months prior to the listing, and as well as the next 3 to 6 months post-listing. Depending on the time when the company comes to the market, it may be, and the market itself, venture market versus main market, the listing may occur closely before or after the quarterly disclosure requirements or semi-annual disclosure requirements. So all of these components should be well planned ahead. And we recommend for senior management and the investor relations officer to have a clear timeline and calendar. What do we publish when? Whom do we want to reach with the communication? What is voluntary disclosure? What is regulatory disclosure, to ensure that all is well planned in advance and communication is most effective. So I touched upon this before, like very, very briefly. But across all these documents, the most important in our view is really to have a very effective equity story of the company and positioning of the company. And from our experience on all the previous transactions Hosam and I have worked on together, as well as the live transactions we're working on right now, we encourage our clients and work with our clients together very early on really developing a specific equity story which fits the purpose, which elevates the company, and most importantly, which positions the company itself compared to other listed companies on the Qatar Stock Exchange. Why is this so important? The listing process and the regulatory approvals, in our view, is one key part of fulfilling the official requirements to become a listed company. But all of this means nothing, in our view, having an approval, becoming listed on the stock market, but not finding any interest by investors. Number one, attention by investors in the media, and number two, having investors actually being excited about the company coming to the market. Which is important for an IPO or for listing on the main market in particular, prior to the listing, because shares are being offered prior to the effective listing date. And for all companies, of course, for the aftermarket performance. We need people to be generally excited about the listing and generally excited about wanting to buy the shares. And in many cases, it is not necessarily about deploying only more money into the stock market, but it's about maybe selling a different company which they have in their portfolio already and investing in our new listing. And this is why, in our view, this is really, really important, and senior management and investor relations officer together with the listing advisor should spend a lot of time and very, very focused on substantiating the equity story. This can be, as you see here on the page, a specific sector focus, a specific exposure that doesn't exist yet on the stock exchange. It can be a focus on competitive advantages versus existing competitors listed on the stock market. It can be an affiliation. It can be an affiliation to a specific sector that doesn't exist. One can be very creative in this, and in our view, one can be creative and should also really consider how the distinction between already existing companies on the stock market can be made. I want to show you this in a very simplified chart, as you can see on this page here. I want to show the potential impact of different perception, of different positioning, and the respective impact on valuation. There are obviously loads of different factors that play into the role of into the result of being perceived attractive by investors as a company. But the one measure that we can see and it's visible to anybody is, of course, liquidity. So the volume of trading, the trading volume effectively on the stock market. And the other component is effective valuation of listed companies. What we are showing here on this page is the price to earnings multiple, so price to earnings valuation of different automotive companies. Since I'm German, we chose the automotive sector. And we just wanted to emphasize here, and just to visualize how significantly different valuations can be of companies effectively being in the same sector. All of these companies ultimately are automobile manufacturers. As you can see on the very bottom left, by far the lowest valuation is Volkswagen Group. Volkswagen Group is currently trading at 5 times price to earnings. And you see from left to right, the companies increase in valuation. BMW is trading at 7.5 times price to earnings. Toyota at 9.2. BIT is trading at, the Chinese manufacturer is trading at 19.6 times price to earnings. And then if you look at the right-hand side, Porsche is trading at 24.5 times price to earnings, and Ferrari 50 times or 49 times price to earnings. What does it mean? It means that if you compare, for example, Porsche to Volkswagen, investors value 1 million euros net profit in Porsche, the same as 5 million euros net profit in Volkswagen. The funny part is, or sad part for Volkswagen, as some of you may know, Volkswagen is a big group of different automobile companies and manufacturers. Volkswagen is the 100% owner of Bentley, of Lamborghini, of Ducati. They also own shares in Porsche. They own Audi, Seat, and some others. However, Volkswagen historically has a fundamental issue of being not the darling of investors. For various reasons, despite a lot of efforts in the past, Volkswagen has a significant issue of investor appreciation. If you look on the right-hand side, Ferrari, for example, trading at 48.5 times price to earnings. Ferrari has an amazing story to investors, very clear communication, very easy to understand story. Quoting the founder, Enzo Ferrari, whose statement was long time back, and Ferrari keeps on communicating this message, is that Ferrari will always produce one car less than there's market demand. Looking at ultimately how different positioning of companies, different communication, clear communication, and understanding of the equity story can impact valuation. I hope that encourages everyone to at least spend a bit of time on this topic because it has such a profound impact on perceived valuation, on positioning, on attractiveness. As said, Lamborghini, that is 100% owned by Volkswagen, effectively right now is trading at 5 times price to earnings compared to Ferrari at 49 times. Key factors on the bottom, as you see, in principle, growth expectations, profit margins, cash flow generation, risk perception, leverage levels, as well as innovation and mega trends are just a few ideas of how one can think about substantiating equity story and positioning towards investors. In the context of many of our clients, for example, with whom we discuss equity stories, just a few examples. A company that is operating in the retail sector. Maybe there is an angle to position the company from the retail sector to high-end retail or to a specialist retailer. Thinking about affiliation with premium brands or with specialized products, specialist agencies for a specific sector. Looking at consumer services, same here, uniqueness of the service being offered, speciality, anything differentiating oneself from the mass market. Similar to the industrial sector, communication services, a clear push towards technology, or on the consumer discretionary, like affiliation with high-end customers with high potential, growth positioning, margin positioning. These are all thoughts that we are evaluating with different clients at the appropriate time. The key is obviously not just to identify the potential, but also show some proof. As mentioned beforehand, building a story is very, very important, but at the same time, we need to ensure that our dear investors or potential investors, as well as all other third parties, don't just understand our equity story and positioning, but also believe in the equity story and the positioning that we are trying to convey. We are listing here on this page a few considerations like that that we always check with our clients on the positioning, easy ones that can shape and can support equity story is a clear management vision. So developing and defining a vision of the company and making this an official public statement also in the prospectus. Historical financial performance and future outlook, of course, has a significant impact. The service offering itself, customers and partners, market coverage, EI, meaning market share and positioning within the competitive landscape, within the respective market, operational infrastructure, competitive advantage, management track record, and the product portfolio are just a few to consider as potential proof and facts to support the building of the equity story. I showed you before the example of some of the automotive or automobile producers, and we thought we also give you a real-life example here in Qatar. Maroon Capital, we were the listing advisor on the direct listing of Daman Islamic Insurance Company, BIMA, in January 2023. And as an insurance company, or as an Islamic insurance company coming in January 2023 to the market, we were not the first Islamic insurance company. We had already, as you can see on the page, we had QIC, QLM, Qatar General, and Doha Insurance as conventional insurance companies listed on the stock market, and we had Qatar Islamic Insurance and Al-Khalij Takaful as two Islamic insurance companies, direct competitors to BIMA. So we spent a lot of time assessing, evaluating, and positioning BIMA compared in particular to the two Islamic insurance companies, Qatar Islamic and Al-Khalij Takaful. Evaluating and assessing how can we best position the company and how can we ensure that, number one, investors are interested, and all other third parties fully comprehend why we believe and management believes BIMA should be valued at least at a similar valuation to those listed companies, or maybe even at a premium for specific reasons. And as you can see on the left-hand side on this chart, we are showing the price to earnings valuation for the respective listed insurance company, and on the bottom part where you see the dotted line around the price to earnings multiples of Qatar Islamic Insurance and Al-Khalij Takaful. This is at the time of the prospectus publication on the 25th of December. Qatar Islamic Insurance Company was trading at 13 times price to earnings historically, Al-Khalij Takaful at 13.8. And we managed to, the senior management and us together as the listing advisor, we managed to list Daman Islamic Insurance Company at a premium to those existing listed company Islamic insurance companies at 14.1 times price to earnings, which was not just ensuring that we received approval from the regulatory authorities on this valuation, but also actually 25% of the share capital was sold to investors. So we managed to not just, together with the senior management team, not just manage to build the equity story and the positioning with the regulator, but also with more than 100 investors who bought 25% of the company at that valuation. In Qatar in particular, the market is dominated by retail investors. Of course, we have lots of institutional investors and corporates who are investing, but the dominant shareholding is with retail investors. So we always try with our clients, emphasize to clients the importance of ensuring that retail investors are engaged in addition to the institutional investors. And retail investors, I think we all know, anybody who ever attended an AGM or any of the listed companies conference calls, very straightforward. Retail investors are a bit more short-term focused than institutional investors, and the key question is always surrounding dividend yield. How much is my dividend, and how much net profit has been achieved? While of course, as mentioned at the very beginning, we don't recommend to give very precise forecast on earnings forecast, revenue, or net profit forecast. There's a way of at least guiding investors to specific communication and to specific messaging. We show you on the next page here the respective dividend policy and communication to investors. So said we worked on two of those, Al-Mahar and Bima. On the top, you see different examples. These are quotes from the prospectus, what these companies said about dividend policy and dividend communication. It's not easy for anybody, we think it's not easy for anybody to commit to a specific communication on dividend policy, and the easiest one is what all four companies, Duhan Bank, Al-Mahar Holding, Bima, and Misa did, is to give a very generic, very broad statement about the dividend policy. Apologies. There are alternative options, which we are encouraging, like some of our clients who are confident to consider, just to ensure more attractiveness and more attractiveness to retail investors. On the bottom of the page, you see like three different approaches on communication of dividend policy and potential payout ratio. Number one is to give specific payout ratio guidance. It's just a guidance. It's not a full commitment. Of course, there should always be language that ensures subject to respective terms. But effectively, option one could be to give a payout ratio guidance. The company management intends to pay out between 60 to 70% of net profits, which, for example, or any other ratio, which could provide guidance to investors. Depending on the timing, there could be a guidance on specific amounts of dividends. That obviously can only happen if we have enough retained earnings and we have a specific dividend policy in place and are very certain that the company has cash at hand to pay certain dividend levels. But effectively, there's a lot of room to ensure that retail investors are really to attract retail investors effectively. Another good example in our view is Al-Mahar Holding. in terms of overall communication and in terms of really using investor relations very effectively to investors. I'll try to keep it short. Like Al-Maha Holding listed on the 7th of June 2023 in the venture market. At the time of listing, the company had a free float of just above 10%, and the remaining 90% remained with the founders of the business. At the time of listing, we had developed together with the company a real strategy of communication and action plan for the next 1.5 years, which effectively included specific actions on the communication front, a clear plan, a clear path of how the company will act on the venture market, and what is the roadmap towards potentially transferring to the main market at a certain point in time. Obviously, we had the events in October 2023, which had a significant impact on our local stock markets as well, beyond all other components. And as you can see, the share price of Al-Maha went below the issue price of 2 riyals. Significantly below 2 riyals, like going down to nearly 1.5 riyals per share, so about 25 below initial issue price. So that was the time when we discussed together with our client, let's make a real push and a real effort to ensure that outside events, to limit the impact of outside events of the strong performance of the company. And I think the efforts that were made at the time included, for example, a roadshow, a non-deal roadshow. Following the results publications, we went together with our client to meet all the investors, all institutional investors in Qatar, plus a few family offices, explain to them the business, the historical financial performance of the company, really focus on the equity story, and really positioning the company like against other companies on the stock market. And I think, as you can see, it worked quite well. The company as well voluntarily issued earnings outlook and earnings guidance, which not many companies do on the stock market. There was a lot of communication, all in line with the overall strategic objective and in line with the equity story and positioning. It took a bit of time for people to fully comprehend and to see, but based on the strong focus on investor relations and proactive approach as well, on the unified messages and interaction, trading volume increased significantly, and a lot of the people who were met on the non-deal roadshow actually became shareholders of the company, supporting an overall sell down of the founders. So the founders sold an additional 15% over the 1.5 years, bringing the free float to more than above 25%. And then we moved Al-Maha Holding from the venture market to the main market. And they are now on the main market, I think, since end of January or some. Sorry, can you correct me if I'm mistaken?
February
on the main market of the stock exchange. And in our view, it's really one of the very good examples where a privately owned company like has decided for strategic reasons to go to the stock market, had a very clear plan and a strategy in place of how to interact, how to communicate, and achieving an ultimate objective, which was transferring to the main market, and also having decent liquidity on a daily basis. IR must-haves for pre-listings, very straightforward. Keep it short. Investor relations officer, in terms of people, CEO, CFO need to be involved. We need to ensure that board members are aware of the respective do's and don'ts. And as mentioned before, and all communication needs to be clear. the journey to a successful listing on the stock market requires a bit of preparation. Repeating a bit what I said before, but in short, we need a clear IR strategy. We need a robust equity story. The key investment highlights need to be very clear and well articulated across documentation, as well as communicated in the discussion with investors. Historical operational and financial performance need to match, of course, the communication. An outlook guidance is great if we can communicate on the outlook and specifics, and strategic investor identification and targeting is very key, depending on the ultimate objectives of the shareholder and the purpose of the listing. May it be valuation and price driven, may it be strategic, may it be opening up to partners, employees, other components, but that needs to be well set out beforehand. And most importantly, point number 7 in our view, don't be afraid on proactive investor outreach, as long as it is aligned with the rules and regulation and in the right framework. Thank you very much. I think I'll hand over to Hosam Mekdad.
Thank you, Sebastian. I will just put on the slides I have. Okay, very good. So, good morning, everyone. My name is Hosam Mekdad. I'm a director at Maroon Capital, and I will pick up where Sebastian left off and speak to you a bit about post-listing or post-IPO disclosure. If I may start with the basics and maybe challenge how we usually think about disclosure. So disclosure is not a checklist. It's how the market forms a first impression of a company, often before they've ever met you. Most investors, especially retail investors, won't call you or meet your CFO. They rely on what's public, what the company publishes. So when you disclose, or what you disclose, that becomes your reputation. And if the first impression feels unclear or inconsistent, investors usually just move on. That's why good disclosure isn't about compliance. It actually builds pricing power. And when your messaging is clear, timely, and credible, you reduce uncertainty. And that makes it easier for investors to act. It increases appetite, liquidity, as well as trust. And this isn't theory. The global data actually backs it up. Strong investor relations can lead up to 10 to 15% higher valuation. It attracts institutional investors, it narrows spreads, and lowers your cost of capital as well. But of course, the opposite is true. If your disclosures are vague, inconsistent, or late, the market assumes the same about how the company operates internally. And once that doubt is in the system, it's hard to price your story properly. We've heard this more than once. One institutional investor told us, if the public disclosures are vague, we assume that the rest of the company is vague too. So from day one, you want to show investors that you're not just compliant, but that you're transparent, credible, and ready to be seen. Now that we've talked about why disclosure matters, let's take a step back and look at the structure that governs it. So in Qatar, disclosure obligations aren't shaped by one rulebook. They're shaped by 3 interlocking frameworks, and it's important to understand how they work together. Let's start with the QFMA listing rulebook. This is your legal baseline. It tells you what must be disclosed and when. This includes things like annual results, board changes, material events, and even things like regulatory notices or legal risks. And there are strict timelines for disclosure, which we'll talk about on the next page. But the second framework is the QSE investor relations rules. These are more operational. They tell you how you disclose and how you reach the market. Everything has to go through the QSE's electronic disclosure system before being published anywhere else. These rules also cover things like having a bilingual investor relations website, when to publish earnings presentations, and even who your investor relations officer should be. And then third, you have the corporate governance code, which is sometimes underestimated. This rule book isn't just about board meetings and it requires companies. Apologies, I think we may have skipped something. Okay, very good. So it goes a bit deeper into how transparency is built into a company's culture. It requires companies to have internal disclosure controls, publish governance structures, disclosure of conflicts of interest, and ensure that shareholders are informed at all times. So if I may summarize, if the QFMA rulebook tells you what, then the QSE tells you how, and the governance code pushes you to ask why. It's important to keep in mind that making disclosure is about mindset. It's not just a task. And you'll see in the slide, there is no hierarchy here. You cannot be compliant with one framework and ignore the others. And especially for companies aiming to list on the venture market, it should be noted that these frameworks still apply, maybe with a bit more flexibility at first, but no less seriousness. The expectations are there and the expectations are high. So when we talk about disclosure, we're really talking about navigating across these three dimensions: legal, operational, and cultural altogether. So now, if we can get practical, what do companies actually have to disclose once they're listed? The way we explain it is simple. There are three categories of disclosure, and each one has its own timing. First, your financial results, what we call periodic disclosure. These are scheduled and pretty straightforward. If you're on the main market, the expectations are clear. You have your annual financials, which need to be audited and published within 90 days. Then you have the semi-annual results, which are reviewed and published within 45 days. And finally, the quarterly results, which are board approved and must be out within 30 days. For companies on the venture market, only the annual and semi-annual results are mandatory, and that gives you a bit more breathing room. That said, many venture market companies choose to go a bit further to share quarterly updates or earnings highlight, as Sebastian has mentioned. And we've actually supported with such disclosures and even releasing earnings guidance on a voluntary basis. And as we highlighted earlier, this was very well received by the market because it sent a signal of confidence and clarity. So while it's not required, voluntary disclosure can be a powerful signal, especially in the early days. Secondly, you have material events. These are things that you didn't plan for, but that investors would want to know about. So let's say a CEO resigns, or your company signs a major contract, or a legal issue comes up. If the event is considered material, meaning it could reasonably affect the share price or investment decision, you need to disclose it within 1 business day. And we'll talk about it a little further on the next slide. But I want to mention that this is less about rules and more about fairness. The market shouldn't learn big news from the media or through rumors. It should hear directly from you and officially. And in our experience, this is where internal coordination matters the most. Delays usually happen not because of secrecy, but because everybody's waiting on somebody else to move first. Finance thinks legal is drafting the press release, legal is waiting for the board minutes, and meanwhile, the clock is ticking. So it's not about blame, it's just about how things can slip through when roles aren't clearly defined. but the impact, unfortunately, on investor confidence is all the same. And we'll talk a bit more about how we can avoid that a bit further down. Just before we move on, the third category is corporate actions. These are your standard announcements like AGMs, dividends, board appointments. They're routine, but they still follow specific timelines. For AGMs, these must be announced 15 days before the meeting. Dividend decisions, board changes, they should be disclosed within 1 business day. These are easy to plan for, but still important, and investors rely on these disclosures to stay aligned. Now, for you considering the venture market, don't be intimidated by the idea of disclosure. Yes, there are obligations, but there is also flexibility. And we've seen that companies start small, but build good habits. They report consistently, even if it's twice a year, they're just setting the right tone with the market. And don't think this is a burden. Think of it more as a rhythm. Once you get into it, disclosure just becomes part of how your company operates. Now we get into one of the trickiest, but also most important areas of disclosure, materiality. This is the moment where many companies pause and ask, do we actually need to disclose this? And the most useful test is this. If the information could change how an investor sees your risk or your value or your future direction, then it's probably material. This could be a CEO resignation, a major contract win or cancellation, a regulatory development, or an unexpected swing in performance. It doesn't have to be negative, and it doesn't have to be big in absolute terms. It just needs to be impactful. One thing that's often missed is that materiality isn't fixed. It depends on your context, size, and visibility. So a 2 million real contract may not be material for a large industrial company, but for a newly listed venture market company, that same contract might shift how investors view the company's growth or risk. The same goes for timing. A development may not seem material on its own, but if it lands during the result season or when your share price is under pressure, it can suddenly take on a lot more weight. So materiality depends on impact, timing, and context, not just about absolute size. And understanding that is what separates companies that react under pressure from those that manage disclosure strategically. So again, don't think in terms of size, think in terms of how the market will see it. So how do we deal with material events in practice, if I may quickly touch upon that? Well, once you've identified something is material, the QFMA rules are pretty clear. You have 1 business day to disclose from the point of awareness or board decision. And you need to disclose this to the QSE, which means to the market, and to the QFMA at the same time. Then you should post a press release on your website. But the reality is that this is where things get nuanced. One of the most common gray areas is strategic deals like M&A. Let's say you're in preliminary discussions for a potential acquisition. Nothing is signed. The board hasn't made a decision yet. But the transaction, if it happens, would clearly be material. In that case, you're not expected to disclose every detail upfront, but you can't also stay silent either, especially if the market starts reacting or if rumors start spreading. What most companies do, and what the rules allow, is to issue something we call a holding statement, something like, as we have here, the company is in preliminary discussions regarding a potential strategic opportunity, no binding agreement has been reached, further updates will be provided as and when available. So as you can see, it's simple, controlled, transparent. It buys you time without, of course, misleading the market. Now, consider a different scenario, one that's unplanned. Let's say there's been an incident at a key site. Maybe you've just received a notice of a regulatory investigation. Maybe some market rumors are starting to catch on, and you're still trying to get clarity. In those cases, the QFMA allows you to issue an initial disclosure. That means you publish what you know, acknowledge what you don't, and commit to updating the market. It's a smart mechanism. We've seen it work really well to get ahead of speculation without creating confusion. But if the situation is clearly significant and you're still not ready to say anything, the fallback is to request a temporary trading halt. The QFMA rules allow for that. It's not ideal, but it's there to make sure that all investors are on a plain level field. The key takeaway here isn't that you have to disclose everything. It's not that you have to disclose everything immediately. It's that, you should think clearly, act early, and communicate responsibly. Materiality, end of the day, is really a judgment call, and it's one that you can prepare for. As long as you have a process, you document your reasoning and involve your board when needed. Now, if we move on to who is actually responsible for disclosure, and I'll touch upon this quickly. I realize we're running a bit out of time. So, as we've said before, disclosure may sound like a legal or regulatory issue, and it is, but in practice, it's a cross-functional process. The market ultimately doesn't care who missed the email or which department was technically responsible. If something material happens and it's not disclosed, the accountability lies with the company as a whole. That's why effective disclosure isn't about ticking boxes. It's about building a culture where people understand what counts as material, who they should inform, and how quickly they need to act. Of course, if somebody has to own the process, that's usually investor relations. They manage the timeline, the communication, and they usually interact with the QSE and the QFMA. But of course, investor relations doesn't operate in isolation. The legal department contributes on regulatory and reputational exposure. Management decides what gets escalated. For example, real information often starts with the business, but then it could potentially escalate to the board of directors. So the question is, who flags the issue? Who reviews it? Who decides? Who presses the send button? If those questions aren't clear internally, then things might get delayed or missed altogether. You'll see some best practices on the slide, simple things like defining internal roles, maintaining a disclosure checklist, as Sebastian mentioned earlier, keeping track of how decisions were made. These aren't just formalities, they're what makes the process work under pressure. And importantly, teams like finance, commercial, and operations should be part of the loop. The goal is not to turn everybody into compliance experts, but to help them understand when something they're dealing with might have broader implications. The early awareness is what allows good judgment to kick in before the market does. So far, we've talked about what needs to be disclosed, who is responsible, and how we shift to how it's done. This is where things start either to work out smoothly or to unravel quickly. The formal requirements are clear. Disclosures must be made through the Qatar Exchange company news system. That's the only acceptable channel. A copy of the disclosure must go to the QFMA immediately as well. So you're disclosing to both the Qatar Stock Exchange and to the QFMA. And then the company's website can only be updated after you've made those two initial disclosures. Everything must be published in Arabic and English using clear, fact-based language. That means we can't have vague statements, we can't have promotional language, and we cannot have selective sharing with friendly investors or media contacts before the market sees it. You also should keep an internal record. What was disclosed, when it was disclosed, and through which channels. I know it sounds a bit procedural, but when there's pressure or scrutiny, the documentation really matters. And a big process is what happens around earnings. Investor presentations and calls are mandatory and must happen within 5 working days of publishing your financial results. This includes quarterly, semi-annual, and annual results. On the right side, we've listed some practical do's and don'ts. These may sound obvious, but they're the areas where most issues come up. Things like announcing something to the media before announcing it through the QSE portal, or delaying disclosure because I don't know, somebody is still assessing it. As we discussed, if it's material, it needs to be disclosed, even if you don't have all the answers here. And a quick takeaway, and please keep this in mind, investors don't expect perfection. What they expect is consistency, clarity, and a fair access to information. The way you handle disclosure is one of the clearest signals of how seriously you take investors, and at the same time, how seriously investors should take your company. Just to touch quickly upon the role of the Investor Relations Officer. And when we talk about the IRO, the Investor Relations Officer, we're not just talking about who uploads disclosures. We're talking about a function that sits at the intersection of legal, compliance, investor confidence, public credibility. From a regulatory standpoint, the QSE has made the investor relations function obligatory, especially for main market companies. You need a full-time, dedicated IRO. They need to have the right qualifications, which are usually minimum 3 years of experience in investor relations, finance, law, or a similar field. And this must be their primary role. It's not meant to be something that somebody handles on the side. For venture market companies, there is a bit more flexibility. The role can be combined with another function, but only if the person who's handling it is competent and is also accessible and actually performing the IR role in practice. The company must keep an updated investor relations website that is both in Arabic and English, and must publish quarterly investor presentations for main market companies. The company must hold earnings calls within 5 working days, as we mentioned. And each year, all companies are expected to submit to the QSE an issuer statement confirming that they have complied with the investor relations rules. And as Sebastian said, when it comes to good investor relations, compliance is just the floor. The real value of investor relations lies is in what you build on top of that. Good investor relations is clear. The message is easy to understand. It's not in complicated legal language. It's coordinated. Investor relations, legal, finance, management are all aligned before anything is said. It's also structured with regular investor touch points and prepared messaging. One more thing I would add is that it's also insight driven, meaning the company knows what the market is saying, what investors are asking, how it's performing, how the company is performing relative to your peers. And it's also forward-looking, not in the sense of making forecasts or forward-looking statements, but in knowing where the company is going, what it's focusing on, and why investors should stay interested. And remember, the investor relations role is important because investors don't speak to a company, they actually speak to a person. That's what really makes the investor relations role very important. And lastly, if I may share with you just a few thoughts. On the left, we've listed some simple practical steps. Start with a basic disclosure calendar, identify key dates like earnings releases, AGMs, dividends. Internally, agree how material issues get flagged and who's responsible for escalating. Keep a record of what you've disclosed and when. Review the IR section of your website every quarter. Make sure IR, legal, finance are all coordinated before anything is released. That step usually avoids most of the typical last-minute stress. On the right side of the slide, we've shifted to mindset. You don't need to have the perfect system from day one, but you do need to have a system that works for your team. Disclosure builds trust, not just with the regulators, but also with investors, analysts, and the market more broadly. Most disclosures are straightforward. Once you've done them once or twice, it's pretty straightforward exercise. Investors, as I mentioned before, aren't looking for flair. They're just looking for clarity. The value comes from being consistent and accurate and responsive. And finally, I would just add that you're not expected to do this alone. The support is built into the entire listing or IPO system. As listing advisors, we always help companies prepare. We assess the gaps, put a plan in place. We walk management through what needs to be done well before the listing or the IPO happens. And even after you list, this support continues. The QFMA now requires venture market companies to have a post-listing advisor for a minimum period of 6 months. This advisor is there to help, to guide, and to keep you on track. So my final takeaway would be, don't worry, it's all manageable. You just need preparation, structure, and the right advice. And if you need support, both the Qatar Stock Exchange team, us, the other advisors, we're all here available to support. Thank you all for your time.
Thank you so much, Hosam and Sebastian, for that journey into IR and how companies can build investor confidence. I don't think we have any questions. So I think with that, we can conclude today's session. Thank you, everyone, for joining us. So our next session will be on Wednesday, inshallah, where we will be covering valuation. Thank you. Have a nice day.
Thank you very much, everybody. Have a nice day.
Thank you, everyone.